that can drive the market up, meaning it'll fuel the market's push here, then they have to take out the people who are trying to sell down here. They're going to have to take out the people who are trying to buy down here. Okay? That's just a really quick overview. So they're going to have to spend their money to push the market down into this area. Also, big trading firms. If big trading firms want to get the price down into this area, they're going to have to actually put money out of their pocket and sell the market until it gets into this area here. Because again, the market maker's not going to help them out. They're not friends. They may be business associates, but they're certainly not friends. So if a big firm wanted to push the market down, the only way that they can do that is to sell, and to sell again, and to sell again, and push price down into this area where they trigger the buy orders. Okay? So that's again another basic overview of some of the reasons why the market makers may have an incentive to move price. Now, another way that markets, another way that market orders are executed, and this is actually what happens on trading desks. So this is again another way for you to understand how big orders are done in the market. If you remember, I was talking yesterday about the value-weighted average price. Value-weighted average price. That's the VWAP. Okay? There are some trading firms which use this value-weighted average price as their trading system. Okay? They actually will glean information from multiple markets because they know that traders who are trying to execute big orders, they don't have a single price. They have what's called a VWAP. And to give you a better idea of what that means is if you take a slice of time, let's say we're looking at the 21st and the 22nd, and we're looking at the price inside of this box, we could run this through an equation and we would have a value-weighted average price that would run something like this. Okay, it'd simply be an average of the trading that was done inside of the box. And again, this is a very high-level, non-complicated way of describing this. Now, the reason why this exists is because if, let's say, IBM, they need to buy 300 million pounds, okay? If they need to buy 300 million pounds, they're not going to go to Deutsche Bank or Bank of America and say, we want 300 million pounds at exactly 1.9680. And we want them all done at this level. No. What they're going to say is we need 300 million pounds and we need a VWAP of 1.9725. Because, and the reason why they're going to say that is because they know unless they do give the order that way, they're not going to get filled. Okay, they're not going to have anybody willing to take their business. So what winds up happening is the trader knows on his screen he'll have a readout based on his position, and it'll say you've got 150 million pounds, and the VWAP of that position is say 1.9680. So he's got a really good price on the 150 million, but he knows he needs a lot more. Well, now that trader can go in and maybe sell a little bit because the market's quiet to push price down because he knows he's got more people to sell down here. So by selling, he pushes the market down, triggers other sell orders, which he then buys. Okay, he's forcing the market down. Let me try and give you an example using a house. Let's say you had your house on the market for $200,000, and you knew somebody else